Good afternoon. We're going to go over our Forex trades for today, Tuesday, May 3rd. Two trades where we finished down 9.1 on a size adjusted basis. On a 9 size adjusted basis, it was actually only 5, about right around 5 pips, but we had twice as more of one. So you'll see what transpired. First, let's just go over the economic news. Last night, Australia cut interest rates to record lows. That was unexpected, as most analysts thought that they would not lower rates. So that caused a lot of volatility in the Australian dollar. One of the trades that we were in was the euro to Aussie, but we got out of that. We had an opportunity to get out a few hours prior to that announcement, so we took it just to book the profits. Maybe took a little early because it went down more, but we'll go over that in a minute. Goldman Sachs was out this morning. They're hinting that the Bank of Japan may hold an emergency meeting if the Japanese yen continues to appreciate. The US dollar, Japanese yen continues to go lower. So if you're trading anything with the yen, you're going to have to keep that in the back of your mind over the next few weeks. What else this morning? There wasn't a lot of regular just economic news, so we picked out a few things. European Commission cut its outlook for growth and inflation across the European Union for 2016-2017. So that's not good. You have the ECB, doing everything they can, buying different government bonds. Now they've gone to corporate bonds and now junk bonds, probably stocks. Some countries in the European Union are negative interest rates, and they're still not creating inflation. Here you have the European Commission cutting forecasts for inflation and growth. Absolutely amazing. Sooner or later, these central bankers are just going to throw the towel in and they're going to give up. We've been arguing all along normalizing rates would probably create inflation, but they're afraid to do that. Why? Because global markets around the world, from stocks to bonds to currencies, will take big hits, and they don't want that. But it just may be something they may have to do to create inflation. And we've talked about why normalizing interest rates would create inflation, why zero-bound rates or here we go, negative interest rates do not create inflation, do not create jobs. But we've gone over that in the past, so we're not going to get into that today. Treasury yields tumbled the most in 3 months, despite the Federal Reserve's Williams warning that treasuries are priced very high. So Williams was out this morning saying treasuries were priced very high, but yet the bond market and bond traders totally shrug them off, and they make bond prices rally, driving down the yield the most in 3 months on the 30-year, the 10-year, the 5-year. So it's pretty funny. You have the Fed saying one thing. They want to raise rates. They're saying that the treasuries, the prices are too high. But you have the market, you have the managers, the bond traders telling the Fed, no, you're absolutely wrong to talk about raising rates and remaining hawkish, as we've talked about in past videos. And last week's interest rate decision, the Fed was very hawkish in their comments. So you have to believe that, or at least we certainly do, you have the Federal Reserve, between the governors and the chairwoman, there's only so many of them, whatever it is, 12 or whatever, and yet you have, they're trying to tell the overall market that they're right, that they need to raise rates because things are growing rapidly, whatever. But you have the entire market, which is thousands and thousands and thousands of participants and billions and trillions of dollars, telling the Fed, you guys are completely wrong. We're going to drive up prices. We're going to make yields go down more. So we shall see what the Fed ultimately does in the coming months. JP Morgan came out this morning. They're pretty much throwing the towels in on equity prices. They said global price to sales is higher today than it was at any time during the 2007-2008 period, which was, of course, the financial crisis. So we've been saying all along, things are just out of whack. Things are going to correct in all markets sooner or later. Read an article today just saying that so many professional traders, they don't understand what's going on with markets. They don't understand why the central bankers are doing what they're doing. They're trying to create jobs and economic growth by keeping asset prices risk asset prices up high. That does, obviously, it does not create jobs, and we've seen it doesn't create inflation. So central bankers need to back off, and they need to go do what they do, and that's monitor economic conditions and lower and raise rates accordingly. What they're doing is absolutely insane. And here's JP Morgan basically telling you, I mean, who's going to argue with JP Morgan? Price of sales metric is higher today than it was at any time during the 2007-2008 period. So I'm certainly not going to argue with JP Morgan. Anyway, let's get to the trades. We had two trades, like I said, finished down 9.1 pips on a size adjusted basis. First one was a scalp in Euro Yen. We didn't have a full scalp because we were risking more than the 30 pips. We had 40% of our normal size. We were long 122.703. Stopped us out 122.300, losing 40.3 pips or size adjusted 16.1. And you can see what it did. It did fall a little lower, went all the way down to 122.11 overnight, and then rebounded overnight by 5:30 in the morning. It was back to where we went long. Currently, it's down about 35 pips from where, right around 30 pips from where we originally went long. So far, this trade's just not working out. We got stopped out. If you're still in it, you might have you have potential here for this thing to work out. Whether it does or not, I don't know. Euro Aussie was the one we were talking about. We were short this yesterday, 1.50290. As it was coming down last night, we had an opportunity. We took it off at 1.49939, picking up 35.1 pips or size adjusted 7.0 pips. Probably got out of it a little bit too early, but again, this was several hours prior to Australia announcing their interest rate decision. We did not want to hold it through that decision. It's a swing trade. We had 20% of our normal size. So maybe we could have pieced out. That's not enough really to piece out. But then again, you don't want to hold it because what if it does? What if you're trying to piece out and this is pretty much the bottom where we cover and it starts to move back up a little bit before that announcement. So why take the chance? So we took it off, grabbing the 7.0 pips on a size adjusted basis. You could see what it did. It fell all the way down to basically 1.493533 area. So we definitely left about, let's call it about 55 to 60 pips on the table. But again, I really don't believe it was worth holding and risking that, because look what happened. This is the interest rate announcement, which was around 12:30, 1 o'clock in the morning on the East Coast here. And you can see what it did. It just ripped up. And you would have been stopped out if you didn't cover it all. But in the end, not the best way to start, but it is what it is. We do have our correlation trade, and we added another correlation trade, which is in EuroCAD to US dollar, Canadian dollar. So we were in that a few weeks ago, worked out nicely. So far, we're in the money on it at this point, but I think it could move higher. Would prefer to be out of this before Friday morning's non-farm payroll. If we're not a big deal, but would prefer to be out of that correlation trade. Like I said, we're in the money now, not all that much, so we're looking for a little bit more. So we'll see what happens. Anyway, so that's it. We're going to wrap it up. If you're still trading now, good luck. If any signals come out, they'll be coming your way. And we'll be back tomorrow, assuming we get some action tomorrow morning. Have a great rest of your day.